What is goodwill? In this video, we will look at what goodwill is, where it comes from, and towards the end of the video, we will demonstrate how it can make a company's stock move higher or lower. Okay, let's get started. Goodwill is an intangible asset that appears on a company's balance sheet. So how does goodwill occur? Goodwill can occur when one company buys another company. So Company A is going to buy Company B. Let's have a quick look at what Company B is worth. Well, Company B has assets like buildings, equipment, and other tangible assets that are valued at $750 million. They also have debt valued at $250 million. Debt is also known as liabilities. So if Company A is going to buy Company B, what will they pay? Well, Company A is going to make the case that the assets are worth $750 million and they have to pay off the $250 million in debt. Therefore, Company B should be worth $500 million. This is known as net assets. Well, Company B points out that they have patents that don't appear on the balance sheet. They also have a strong brand and customers that are loyal to them. This is surely worth something. Well, how much? So negotiations continue, and ultimately, Company A agrees to pay $900 million for Company B. For Company A, this will add to their product offerings, and they project how much free cash flow Company B will bring in for them, and they are more than okay with paying $900 million for Company B. Well, that extra $400 million over net assets will be put on Company A's balance sheet as goodwill. So is goodwill good or bad for a company? Well, it depends. Is that $900 million price tag truly a good price? If it is, then Company A should continue to grow and Company A's shareholders will be very happy. In that case, it's a good thing. But what if Company A should have only paid $700 million and not $900 million? So for Company A, after they make the acquisition of Company B, that $400 million will just sit on the balance sheet. It won't grow unless they make another acquisition. But unlike most assets that depreciate or fall in value as time passes, goodwill does not. It is considered an intangible asset, and each year, goodwill must be tested for impairment. Basically, this means that the company is required to keep checking every year to see if they overpaid for Company B. If it turns out that they did overpay, perhaps cash flows have been weaker than they expected, and they now realize that they should have only paid $700 million and not $900 million. If that's the case, then Company A must take what is known as a goodwill impairment. So Company A will reduce their goodwill from $400 million down to $200 million to reflect the difference of the price they should have paid from $900 million to $700 million. And that $200 million decrease from goodwill must also be put on the income statement as an expense. This will lower net income and reduce earnings per share, which will likely spook investors and make the stock price fall. This whole process is why it is crucial for a company not to overpay when they make an acquisition. Well, what about the flip side? Is it possible to pay less than net assets? In our example, let's imagine that Company B was in trouble and needed to sell right away. Well, now Company A has much more leverage, and they say they're not willing to pay more than $400 million for Company B, even though Company B has net assets worth $500 million. Well, Company B is desperate, so they agree. Well, in this case, Company A would actually add a negative $100 million to goodwill, and they would add $100 million to their income statement, except this time it would not be an expense, but it would be considered a gain. So net income would be higher, and earnings per share would be higher. This would likely lead to excited shareholders and possibly a higher stock price. Ultimately, buying a business for less than net assets is not nearly as common as paying more than net assets, and therefore increasing goodwill. This is why you will often see companies being bought out at a premium, thanks to goodwill and the value of that brand. But if you're ever curious about the details of where goodwill came from for a specific company, you can check the footnotes of the financial statements or company press releases, and you should be able to find it there. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.